Okay, so hello everyone, and welcome to day 4 of this ACCA webinar for paper AFM P4 Advanced Financial Management. We are starting just around 6 to 7 minutes later than scheduled because the attendance in the beginning was quite low. Therefore, I just took 6-7 minutes extra to start the class, and don't worry, we will make sure that this 6-7 minutes extra is compensated. Okay, now the first thing which we are going to cover today, although the topic for our day 4 is Black-Scholes option pricing theory, but the first thing we are going to discuss today is to refer towards our last class question. Okay, and from that last class question, we will firstly cover our last thing that is left, that is options. I will just give you a quick recap of that as well, and then we will move towards the new topic. You all have the question with you, and if you want to see the question on my screen, you can view it on my screen. If you want to see the question on the file which you have, which was shared yesterday, you can refer to that as well. So basically, the question was, Vertical was based in Eurozone. Okay, the company was based in Eurozone. It was in Euro. Okay. Assume it is now 1st October. I'm going towards the second paragraph just to make sure that we cover the important things because we have already read the question multiple times in the last class. So you needed to assume that today is 1st October 17. Treasury function has just received information about a future transaction by a newly acquired subsidiary in Euro, local currency the dinar. Subsidiary expects to receive dinar 27 million on 31st January 18. And it wants this money to be invested, means deposited locally for 5 months until 30 June. Vardicol's treasury team is aware that economic conditions are currently uncertain. The central bank base rate, that is LIBOR, bank rate is 4.2. Treasury team believes it can invest funds at central bank rate less 30 basis points per 3%. However, treasury staff have seen predictions that central bank base rate could increase or decrease by 0.1 or 0.6 between now and 31st January. So there's always a risk that when you're investing money later, there's always a risk that rates may go up, rates may go down. Vardicol's treasury staff normally hedge interest rate exposure by using whichever of the following methods, that is FRAs, futures, and options. You were given information about local bank in your area with which Verdicol has not dealt before, has offered the following FRA rates: 4-9, 5.02, and 5-5. The treasury team has also obtained the following information about exchange traded dinar futures and options. 3-month futures are dinar 500,000 contract size. Prices are quoted at basis points at 100 minus percentage. December, March, June futures are given. Okay. Options data 500,000 contract size. Premiums are in percentage. There were 2 strike prices given: 94.25, 95.25, and you were given with the premiums for calls of 3 months and puts of 3 months. Okay. And then after the information, the question stated. Recommend a hedging strategy for 27 million investment based on hedging choices which company is considering. If interest rates increase by 1.1, decrease by 0.6, support your answer with discussion. So suppose that the company is considering 3 hedging choices. You need to recommend which is the best one if interest rates could increase or decrease. Okay. So we needed to decide to recommend the appropriate strategy if interest rates increase or decrease by 1.1 and 0.6. So I told you that in order to recommend which is the best one, we first need to solve all 3 and then decide. Okay. So first one we started was FRA. Now, before starting the question, I told you to incorporate 4 things with you. Okay. The case, the borrowing deposit date, today's date. Okay. And together with this, till what time we are borrowing or depositing, right? So today's date was 1st October 17, borrowing or deposit date was 31st January 2018 until when? 30th June 2018. And the case was of depositing. Okay, you started FRAs. Now, which FRA to choose? We said that today is 1st October. We plan to deposit on 31st Jan. That counts to 4 months. 1st October to 1st November, 1 month. 1st December, 2 months. 1st January, 3 months. And 31st January, 4 months. We need to borrow after 4 months or deposit after 4 months for 5 months. So the relevant FRA was 4x9. We took that 5.02% and then found the actual return on deposit and gain loss due to FRA. So return on deposit was the amount into rate of interest into time period over 12. Gain loss was the difference in what was the rate versus what was the FRA rate into time period over 12 into amount. Now gain loss, if the rates increased by 1.1 became 5.3, but you locked at 5.02, you were in loss. Loss should be deducted because it reduces return. We deducted it and got the answer. And if rates became decreased by 0.6, 3.6, and you locked at 5.02, that was gain. Gain increases return, added. The net answer of FRAs is always going to be same in both cases. Okay. Now the second issue was futures, which is a technical issue. So the first thing, which futures to opt. So we told you there are 7 steps. The first step was to find the number of contracts, amount over contract size into time period over 12. Okay, so we found 5 over 3, sorry, number of contracts as 90. Then basis rates, that is spot minus LIBOR, less futures price. Futures price were 3. Which one to opt? We need to borrow a deposit on 31st Jan. We don't have January future available. We will take the next one, March. Okay, then unused basis risk into extra months. So for 31st January, you took 30th March contract, 2 extra months over total months for 6. Then future closeout price in both cases. The first case was increased by 1.1, second case was decreased by 0.6. So spot minus LIBOR. In increased case, it was spot minus LIBOR, increased by 1.1, 5.3, and in decreased by 0.6, it was 3.6. Less futures price, that was less unused basis, you got future closeout price in both cases. Then you found tick. If it is not given, tick was not given, we found it. And after tick, that was the outcome of hedge in both cases, increased by 1.1, decreased by 1.6. We wrote actual return on deposit like C, and gain loss due to futures. So difference in futures price and the closeout price. Futures price was given, closeout price was given, and the strategy in deposit was buy now, sell it. Into spot, into contracts, into tick, we got the gain loss. The answer of futures is also going to be the same in both cases. Okay, increase as well as decrease. And the last thing was interest rate options. Okay. Now, as far as the interest rate options are concerned, I told you options have a format as well. First one was make heading of 2 cases, increase by 1.1%. Okay. And then decrease by 0.6%. Okay. was a 7-step or 8-step approach. The first was to note the exercise price of options compared to future closeout price, which should come from futures exercise yes, no. Fourth, gain in basis points. If yes, obviously if it's gain, then only it's yes. Then it's total gain, actual cost of borrowing or actual return on deposit. This was the case of deposit. So actual return on deposit from futures. Finally, premium payable. You get the net cost or net return. Net return. And finally, the effective interest rate. Okay. Okay, so let's start. Now, if you open the question, exercise price of options. So remember, we did we have to do on 2 exercise prices because 2 exercise prices are given. So we already did the first one in the last class. So we will discuss the second one. What is the exercise price of option? The second one, it's 95.25. So I will firstly write 95.25. Okay, this is the exercise price of options, 95.25. Now you need to compare it with futures closeout price from futures. So we already computed futures closeout price in futures. So let's see what is the future closeout price in futures. So in case of increase, I think it was 94.36. And in case of decrease, it was 96.06. Okay. Yeah, I need to decide exercise yes. Now the strategy was buy now, sell later. Remember, buy at this price, sell at this price. So buy now at 95.25, sell at 94.36. Buy at 95, sell at 94. Exercise yes or no? The answer should be no. Okay, but the strategy is buy now, sell later. So buy at 95.25, sell at 96.06. Okay, so this is going to be a gain. So yes. So next, gain in basis points if yes. So this is not yes, so 0. This is yes, so you can take the difference. It's 0.81%, so 0.81% means 81 basis points. 0.81% means 81 basis points. Okay, then the total gain. It's the gain in basis points into number of contracts into tick. So gain in basis points into number of contracts into tick. This makes it 0 because there is no gain. And this makes it 91125. Okay, then actual return on deposit or actual cost of borrowing from futures. So actual return on deposit from futures was increased by 1.1%, 560 to 500. And decreased by 6%, 371 250. Okay. Now finally the premium payable. So premium rate into spot into number of contracts into tick. That's what premium is basically calculated as, premium rate into contracts into spot into tick. So what is the premium rate? We have taken the second exercise price, right? 95.25. So do you take a call option or a put option? In deposit, you take a call option. So only calls are relevant. And December, March, June, you have already selected the March one. So March premium is 0.09. March premium is 0.098. So it's a 0.098 into spot 100 into contracts 90 into tick 12.5. So the premium is going to be 0.098 into 100 to 90, 12.5, 11025. Okay. So you will get the net return on net cost. So premium, it has to be paid, which reduces return. Therefore, I will deduct it. Double 51475. And premium has to be paid, reduces return, deducted, but gain increases return, therefore added. So finally, 371250 minus 11025 plus 91125. It's 451350. Now there should be a flurry of questions that you told us that both options always give the same answer. Okay, that's why I prolonged this topic to today's class as well. In forward exchange contract, the answers of both will definitely be same. There is no exception. In futures, the answers of increase decrease will also be same, but in options, the answers can be same as well as different. Okay. In the first exercise price, it was same because both options were yes, yes. But here, one option is yes, one is no, as you can see. So answers can be different. And you can find the effective rate by the net divided by amount into 12/5. So the effective interest rates of both options are 4.01%, And here the effective rate is 4.9%. Okay, now you have effective rates of all techniques. Which is the best one? Remember, when you are borrowing, the case is borrowing, you select the one which is offering the lowest effective rate percentage. But in case of deposit, we will select the one offering highest rate percentage, and whichever is the highest, that will be selected among all three techniques. Okay, this sums up our interest rate risk management. You can note that, and shortly we will start our Black-Scholes option pricing theory after taking your questions if you have. Thank God, Bharti, after 7 messages, you finally realized your calculation mistake. Anyways, Anatoly, there are multiple approaches, but my approach is in currencies, we follow lock-in rate strategy, while in interest, we follow the basis strategy. Moin MD, this is a question which is asked by many students. I don't know, there might be some people who have studied like this, that only one exercise price working is required. No, you can see the market scheme, both exercise price workings is required. Mukhtar, because you hedge yourself against fall and gain both. So no matter whether rates are rising or falling, your amount is fixed. That's why they match. Keshav Nageshwar, the actual return on deposit is directly copied from futures. It's spot. Shalima, you can just WhatsApp me your query because I don't know what it is mentioned in the discussion, and I will see the discussion and let you know. Kritika, we are following a standard pattern. So obviously, if we enter into any area of different from the standard pattern, then we have to compromise some other area. So obviously, if we continue with some other techniques or this interest rate risk management today, then obviously we are just left with one day. Either we have to do Black-Scholes or mergers. Both won't be possible to get covered in a single day. Therefore, we have to start options, and you can refer to a message me in private on my WhatsApp to find a solution for your extra queries. Okay, so our today's topic is option pricing theory, also called Black-Scholes option pricing theory, also called option pricing theory by Black-Scholes. Okay. Jagat Rajpakse, in that case, Shoaib Assam, can you please just WhatsApp your number here? I will check. Jagat Rajpakse, sorry, your question remains unanswered. How do we get the futures closing if only options method is tested? That's a very good question now. From Jagat, and I'm discussing this question because I think everyone of you should know this, right? Now the student is asking, how do we get the futures closing price if only options method is being tested? Remember, in the format of options, there are two areas where we say, okay, write futures closer price from futures, actual return on deposit from futures. So he's asking, what if futures is not tested in the paper? Only options is tested. So what do we do? In that case, you have to find the future closer price, that is step 4 of futures, under any circumstances. Even though future is not tested, but still you need future closer price for options. That's why you need to do futures working till step 4 definitely. Okay. Now, Bharati, your question doesn't make sense here. Can I use this borrowing put option, but if contract size is in different currency? That's not possible because the currency issue only arises in currency risk management. In interest rate risk management, there is no issue of currency. You need to borrow or deposit. So obviously you will borrow or deposit in your country. So the countries don't shift in interest rate risk management. So that is not a possible question which even happens in real world. Soheb, I haven't received any text of yours on my number. So once you will send me your number, then I will send you the group link. I haven't received any WhatsApp text from you, or you are not sending from this number. Okay, so let's move towards the next topic for today. That is option pricing theory, also called option pricing theory by Black-Scholes. Okay. Now, before starting and rushing towards the computations area, okay, this is an option pricing theory. So let me give you some introductory information about what exactly is an option. Okay, what exactly is an option? Let me just tell you what exactly an option is, and then we can move towards this option pricing theory. Now, let's suppose you want to invest in shares. For example, you want to invest in shares. You bought 1,000 shares of a company at $2. Please pay attention. For example, you want to invest in shares. You have made up your mind that I will invest some money, so you decided to invest in shares. You bought 1,000 shares of a company at $2. Now let's suppose the share prices start moving up. Will you get a gain? Yes, and you will be happy. But what if the share prices start moving down? You will start suffering loss and you won't be happy. You may want to back off from this arrangement, but you can't back off because you have already bought the shares. They're in your account. So if you want to back off, you can't because the shares have arrived in your account. Now, if you have to back off, sell it, incur loss, and then go away. You cannot back off from this deal. Okay. Similarly, let's suppose you already have 1,000 shares of a company which you plan to sell. You already have 1,000 shares of a company which you plan to sell. Now let's suppose you sold 1,000 shares for $5. You sold these 1,000 shares for $5. And the next day you start witnessing that the market prices became 6, 7, 8, 9, and you just or your mind stops working that what mistake did I make? I sold my 1,000 shares for $5 and the prices became 6, 7, 8, 9. Had I waited, I would have had more gain, but I sold them and now the prices start increasing. There is no point in backing off from this deal because you have already sold shares. You can't back off. Now that means if a person buys shares and the prices start going down, there is no option of back off because he has already bought shares. Similarly, if a person sells his shares and suddenly the prices start moving up, he cannot back off. He cannot do anything because he already sold. So to protect investors' interest, there is an other type of opportunity in the market which is called options. It has a complete separate market, the options market. In options market, if you want to invest in shares, you don't buy 1,000 shares at $2. You only acquire a right to buy 1,000 shares at $2. You don't buy shares. You only acquire right to buy 1,000 shares at $2. And you know under what conditions? You didn't buy shares. You only got the right to buy 1,000 shares at $2. Promise, right to buy shares at 1,000 shares at $2. On the condition that if prices start moving up, became 2.3, 2.4, 2.5, 3, 4, 5, the prices start moving up. I acquired right to buy 1,000 shares at $2. Not, I didn't buy shares. I only bought right to buy 1,000 shares at $2. If the prices became 3, 4, 5, I will exercise my right to buy 1,000 shares at $2. Exercise my right, get these shares for $2, and then sell it for 3, 4, 5 in the open market and earn heavy gain. And the condition is that if the prices start going down, 1.5, 1.4, and I start incurring loss, I will back off from this deal. So see how much investor is protected here. If he just goes randomly in the market and buys 1,000 shares, there is no U-turn. He has bought shares. Now, if the prices go down, he will definitely suffer loss. But if he just takes a right to buy shares at $2, he's protected so much that if the prices start going up, he will exercise his right to buy 1,000 shares at $2, get 1,000 shares at $2, sell it for 3, 4, or 5 in the open market and earn gain. But if the prices starts going down, he will back off from this. Similarly, let's suppose you already have 1,000 shares you plan to sell. For example, you have 1,000 shares and you plan to sell. If you sold these shares and the prices starts going up, you will suffer loss. Okay. Go in options market. Go in options market. You have 1,000 shares which you plan to sell. Don't sell the shares. Just acquire right or promise to sell 1,000 shares at $5. You didn't sell shares. You didn't sell shares. You just got a right to sell shares at $5 on the conditions that it's a right, not an obligation. That if the price starts going down 4, 3, 2, I have already acquired right to sell 1,000 shares at $5. I will exercise my right and sell shares at $5. Sell the promise at $5 because the prices have starts going down. I already got a right to sell shares at 5. The prices are going down. I will exercise my right and sell shares at 5. But if the price starts going up $6, $7, You just acquired right to sell shares at 5, but now the shares are going in the market at a higher price. You back off. Leave the right and go in the open market and sell it for $67. So see how much investors are protected here. You are acquiring a right to sell shares. If the prices go up, you just back off. Don't sell your shares at 5, sell it for 6 or 7. Sir, is this only in shares market? This is in every market. Okay. You can consider the example of Forex market. Let's suppose in Pakistan, the currency is PKR and the dollar rate to PKR is PKR 160. Dollar rate to PKR is PKR 160. Okay. Now, for example, I have decided to invest in US dollars and I've decided to buy $1,000 at 160. I've decided to invest in US dollars and I bought $1,000 at 160. Now let's suppose prices starts going down 158, 157. I will be in loss. There, the protection is options market. Don't buy $1,000. Just acquire a right to buy $1,000 at 160. What are the conditions of the right? You just got a right to buy $1,000 at 160. On the conditions that if prices go up 162, 163, 164, I will exercise my right to buy 1,000 at 160. But if the prices go down 155, 156, I already got the right to buy $1,000 at 160. Now the prices have fallen, I will back off. This is options. Let's suppose you already have 1,000 shares. Okay. And you plan, let's suppose you already have $1,000. You plan to sell. If you sold and the prices go up, you will suffer loss. Just acquire right to sell shares or right to sell dollars at 160. On the condition that if prices go down, I will exercise my right and sell for 160. But if the prices go up in the market, I will be selling it for 160 to 163. I will back off. Now, if the investor is offered so much protection that, okay, don't buy 1,000 shares, don't sell 1,000 shares, just take a promise to buy shares at 5, sell shares at 5. If the prices go in your favor, exercise the right, and if the prices go in your favor, sorry, that you bought 1,000 shares and the prices starts going down, exercise the right and take at 5. And if the price starts going down, back off. Similarly, if you bought, if you decided to sell some shares, don't sell shares. Get a right to sell shares at 10. If the prices go up, back off. If the prices go down, exercise it. Now, if the investor is offered so much protection, that won't be for free. Correct. When you enter into options, options is giving you so much security that you get a right to buy shares at 10. If the prices go up, you exercise your right, get it for 10. But if the prices go down, you back off. So if you enter into options market, that's not for free. You have to pay a small premium while entering into options market. You have to pay a small premium. How this premium is computed? This is computed through a theory called Black-Scholes option pricing theory. So the purpose of Black-Scholes option pricing theory is just to find the value of options. How much premium we should pay when entering into options. This basically is computed by Black-Scholes. Okay, any questions up till now? Yes, Femida, you won't enter it for free, you have to pay premium. Yes, Ayuni, the basic purpose of option is to protect investor from loss. Like if you just directly buy shares and you directly sell shares. If you directly buy shares and sell shares, there is no U-turn. Buy shares means if the prices go down, you have to bear loss. Sell shares at 10 and the prices go up, there is loss. But if you enter into options, just take a promise to buy or sell. And if the prices are going against you, exercise your right, get it for 10. If the prices are going up and you're still getting for 10, if you are getting a right to sell for 10 and the prices go down, exercise and sell it for 10. But if the prices are in your favor, if the prices are going down, you can back off. Yes, Abid, value of options is the value of premium. Mohammed Afzal, I don't know how much area I will be able to cover today, but to make sure and you can be completely satisfied on this, that we will try to cover as much detail and options as we can. Now, Safar Rahim, your question is interesting. How the option seller makes a profit. Now, basically, this is a game of two like-minded parties who both are willing to enter into options without any obligation, so that both can back off. Okay, but their reading is different. Like, for example, you have seen that, for example, you want to buy a property. Okay, you want to buy a property. You see that the seller is asking for $10,000. For example, the seller is asking $10,000 and you give him offer of $6,000, and suddenly the deal gets locked at $8,000. The person who is selling, he thinks that $8,000 is a good price. I won't get higher than that. Okay, but the buyer considers 8,000 as a cheap price. So the mind reading is different. That's why the deal is locked. Similarly, if I am going to the option seller and he's giving me a right and offering me protection, he is thinking that the prices will go in his favor, whereas I think prices will go in my favor. But I can back off anytime and my premium will be lost. So still, he will still gain from the premium. Yes, Hazik, if you don't exercise the option, you just back off, you have to leave the premium. And it's quite good because it protects you from the risk. Now, just a thought came in my mind that options are so much incorporated in our real life. Options are so much incorporated in our real life that even if you travel, the airlines have started using this option pricing theory. Airlines have started using this option pricing theory. Just this thought came in my mind that airlines have also started using this option pricing theory. Remember, for example, you want to travel from Pakistan to, let's suppose, UK. You want to travel from Pakistan to UK. And let's suppose you checked the dates at an airline website. The fares were coming, let's suppose, $800. The fares were $800. That's a very common issue with the travelers. Let's suppose you buy the ticket for $800. Okay. And after 3 or 4 days, when you again check the fares, you are getting the ticket for $600. So what did I do? I should have been more patient. I just bought the ticket for $800 and the next day I'm getting it for $600. That's for loss. Next time you decided to be patient, you didn't book the ticket right till the end, and suddenly the fares became $1,000, $1,500. So what did I do? So airlines have started giving you one thing. Let's suppose you are getting a ticket for $800. You're getting a ticket for $800. There's always a chance that ticket prices may go up if you buy here and the prices go up, but if you buy and the prices go down, there's always a risk. So airlines say, okay, don't buy the ticket. Just buy option to get ticket for $800. Don't buy the physical ticket, just buy option to get ticket for $800. What are the conditions? If after a few days the prices go to 900, 1000, 1100, you still have the option to the promise to get the ticket for 800. Even though prices are 900, 1000, 1100, you will still be eligible to buy the ticket for 800. Protected. But let's suppose after a few days you got the option to get the ticket for $800 and the prices became 500. You're getting it at a cheaper price. You promised to take it for 800. Back off. Will the airline give this protection for free? No. You can check the website. Airline charges a small premium from you, $20, $30 of entering into option, because it is protecting you. Protecting you. That if the prices go down, you can back off and buy at a cheaper price. And as prices go up, you still will be able to get for 800. Naseem Khan, any party like exchanges, Nesper, please be more specific. There are 3 examples in front of you. One is dollars, one is Forex, and one is airlines. So which example you are talking about? Okay, so I said that let's suppose we want to travel from Pakistan to UK and we checked the fare on the airline's website. The fare was $800. I bought the ticket. Suddenly, after a few days, I again checked the fare. I was getting the same ticket for $600. So I said, okay, what did I do? What the hell mistake did I make? I should have waited. So airlines give you now the opportunity. Don't buy the ticket for $800. Just take an option to get ticket for $800. Option to get ticket for $800. The condition is that if the prices go up, become $1,000, $1,100, $1,200, you still have the option to get the ticket for $800. Exercise the option, get it for $800. But if the tickets fall to $500 or $600, you promised it to get it for $800, but you're getting it at a cheaper price. Back off from the option. So they won't give you this protection for free. They charge a premium. How this premium is computed? This premium is computed through Black-Scholes option pricing theory. So that means the basic purpose of Black-Scholes option pricing theory is to calculate the basic purpose of Black-Scholes option pricing theory is to find the okay. Now in real market there are two type of options. If you want an option or right to buy something, this is called call option. Okay. And if you are taking option or right to sell something, this is called a put option. Right? If you want to buy shares, buy forex currency, the US dollars. If you want to buy anything, if you buy and the prices go down, you're in loss. If you take a right to buy anything, this is called a call option. If you have already got that thing and you plan to sell, if you sell and the prices go up, you can't do anything. If you just take a right to sell, that's called a put option. Now, some options are called American style options, and some options are called European style options. Okay. Some options available are called American style options, and some are called European style options. Okay. The only difference between these two is that both give a right protection to the investor. They have a flexible expiry date. European style options have a fixed expiry date. Okay. Like for example, someone is giving you option, a right to buy or sell something. That option won't last forever. It would have some time period, 2 months, 3 months, 6 months, 8 months, 1 year. American style options have a flexible expiry date. Okay, the date is 2 months. It expires in 2 months, but we can settle anything earlier as well. Whereas European style options have a fixed expiry date. 2 months means it would be exercised right at the end of 2 months. Okay. BSOP, this Black-Scholes option pricing theory which we're covering, is only dealing with European style options. American style options which have flexible date, they are not a part of your sales. Okay. So now coming to the major area, Black-Scholes option pricing theory is primarily used to find premium. Black-Scholes option pricing theory is primarily used to find premium because whenever you try to enter into option, you have to pay some premium. This will be computed BSOP. How does BSOP finds premium? How does BSOP finds premium? That's an important thing, that BSOP is used to find value of premium. So how does BSOP find premium? Black-Scholes option pricing theory finds premium through a formula. It's a technical formula, but the good thing for you is that this formula would be given in the exam. Let's have a look at the formula. Okay, so Black-Scholes option pricing model is basically used to find the value of premium, whatever answer BSOP does, because no one is going to give you option for free. No one is going to give you option for free. Whenever someone is going to give you, okay, take from me option to buy, option to sell, and there's such a security that if things go against you, back off by paying a premium. How this premium is computed? It's computed through BSOP. So how does BSOP compute this premium? BSOP computes this premium through a formula. Now BSOP has to compute premiums for two options. One option is call option, sometimes option is put option. So how do we compute value of call option? How do we compute value of put option? BSOP has some formulas to find value of call and put option. Now let's see, these formulas will be given in the exam. That's from the real exam and the formula sheet will be provided to you. BSOP finds value of option. If the option is call option, BSOP finds value as follows. Call C is equals to PA ND1 minus PE ND2 E minus RT. Okay, and just go right to the end. How does BSOP compute the value of put option? Put option is P equals to C, call option value minus PA plus PE E minus RT. Okay, now if you look at this, you have got 5 variables. Okay, BSOP is using formulas to find the value of call option and BSOP is using formulas to find the value of put option. I just passed my way through the formula of call option and through the formula of put option. How does BSOP find the value of call or put option? I noted the formula that was given in the exam. It has 5 variables, PA, PE, RST. Now what is PA? PA stands for current share price. PE stands for exercise price. PA stands for current share price and PE stands for exercise price. Now, what is the difference between current share price and exercise price? Let's suppose the current share price is $2. Current share price is $2. No one is going to give you option, a right to buy share at $2. Why would I give you option to buy share at $2? The market price is $2. You can go and take it from the market. Okay. If the current share price is 2, most probably I will be giving you option, right, to buy these shares for 2.2, for example. Maybe I'm giving you option to get these shares for 1.8. This is called the exercise price. Current price is what is in the market, but at what price I am giving you the right to get these shares, that is the exercise price. Okay. R stands for risk-free rate. Okay, whatever is the risk-free rate in the market. S is called standard deviation or volatility, because prices are usually volatile in the market. And T is the time to expiry in years. T is the time to expiry in years. Now, if the time to expiry is 2 years, the option is valid for 2 years. Take 2. But if the time to expiry is 6 months, the option will require in 6 months. You cannot take 6 because time to expiry must be in years. So it should be 6 months. That means 0.5 years. Fahad, the first thing I told you is BSOP is used to find the premium, because whenever we try to enter into options, right to buy, right to sell, no one is going to give you it for free. They will charge premium. So how do we get the premium? That's through BSOP. So BSOP finds the value of call and put option, both options. I've shown you the formula of call and put option that will be given in the exam. But in those formulas, you use PA, PE, RST. So I've told you what is PA, current share price, PE at what price you are able to exercise. R is the risk-free rate, S is the deviation, and T is the time to expiry in years. Okay. Now, I would advise you, just a second, please. Okay, now I would advise you that if you want to apply call and put option value in the exams, okay, so you will see at the formula, and there are 5 things in the formula. I have told you what does these 5 things mean, but together with these 5 things, if you look at the formula, there are 2 more things coming in the formula: PA, PE, ERT, etc. D1 and D2, and D1 and D2. What is this ND1 and ND2? Now, this ND is the normal distribution value. This is the normal distribution value. Okay, this ND stands for normal distribution value. This normal distribution value is computed through a table, and you will be given that table in the exam as well. Like you see that in the exam, you are given with the present value tables. In the exam, you are given with the annuity tables. Similarly, you are given with this normal distribution table. From that, you find this normal distribution value. Now, I would advise you that if the question asks you to find value of call, value means premium, and put option. If the question asks you to find the value of call option, and if the question asks you to find the value of put option, obviously you will use BSOP because that's the only model to find value of call and put option. Okay. But when you are attempting BSOP, follow this 5-step approach. This will make things easier for you. Follow this 5-step approach. Whenever the question asks you to find value of call and put option, follow this 5-step approach. You have to use BSOP to find value of call and put option. The formula is given. The first step is to find PA, PE, RST from the question. Just try to find PA, PE, RST from the question. All these values will be given. You have to find them from the question, but there's a guarantee it will be given. Step 2. Find E power minus RT, because that's also a thing you did in BSOP formula. See, E minus RT. Right in the corner, E minus RT. Now this E is the exponential value of the calculator. E is the exponential value of the calculator having a fixed value 2.7183. You can even go to your calculator and just find the value of E, which is written in scientific calculator. The value is fixed 2.7183, power minus RT. R is the risk-free rate and T is the time to expire in years. Step 3 is to find D1 and D2 of BSOP. Step 4 is to find ND1 and ND2, the normal distribution values. Okay. And step 5 is to find value or premium of call and put option. Okay. Now, this is not the case that if you don't follow this 5-step approach, you will lose marks. This is not a standardized approach. This is just made by me. But if you want to find the value or premium of call and put option, immediately you will use BSOP. But how will you use BSOP? It has so much formulas, but the good thing it's given. You just have to place entries in the formula. You need to use a 5-step approach: PA, PE, RST, P minus RT, exponential value that's constant, D1, D2, and D1, D2, and find the value of call and put option. I will take your questions and then we will discuss how do we find value through these options. Mohammed Yunus, the value of call and put are basically the premium. Yes, Anjali, there is no difference between CB and paper-based exam apart from what you have to solve on Excel. That doesn't mean in CB you will not get formula sheets, and there you will get formula sheets. So it's standard everywhere. Aisha, yes, these options are everywhere. You discuss options in currency risk management. There was an option that's the same, that's giving you right, not an obligation. Therefore, you have to pay premium. In interest rate risk management, you also get these options. In appraisal, you also get these options. Amna, I haven't heard anything like traditional options in my whole career, but the real options and the non-options thing. Real options just add flexibility. There's nothing like real life options. Okay, there's just real options and no options. Okay, so if there is no option, there is no flexibility. Once you buy and you sell, you get stuck. In investment appraisal also, once you invest in the project, there is no flexibility, you get stuck. Whereas this real options, this is what is covered by BSOP. This real options gives you the flexibility that you can back off. Okay, in investment appraisal, once you enter into a project, you can tailor that project, modify that project. So this is basically what real options is, but there's nothing like real life options or traditional options. Abid Hussain, obviously the calculation of premium is going to be different if you are taking a call option buy or a put option to sell. Okay, had it not been different, it would have been same. For example, that the call option and put option, you are getting it for the same price. So a person would not, no one would be benefiting because they're buying as well at the same premium and selling as well at the same premium. So no one is going to earn anything. There is a difference in price because the buying rate and selling rate, they're always different. Buying means call, selling means put. They're always different. So that one party at least makes a gain. Like let's you go in an open market and you say why there is a difference between dollar buying rate and dollar selling rate. If the currency dealer's buying rate and selling rate is the same, what is he doing there? There has to be a rate difference so that one party at least benefits. Yes, Mohammed Taghi, it's the fixed amount because if you go in the calculator and you will see one E exponent and just press equal to, it's going to show you this 2.7183. That's a fixed one. Okay, so now we have taken the questions and let's just move towards the question, which we're planning to do today. Open the handout. Okay, so Alaska salvage, the question is in front of you and you can watch it on the screen or do it on your own. Alaska salvage is in discussion with potential lenders about financing an ambitious 5-year project searching for lost gold in Central Atlantic. The company has had great success in the past with its various salvage operations and is now quoted on the London alternative investment market. The company is currently financed by 120,000 equity shares trading at $85 per share. Okay, so company is financed by 120,000 equity shares, which are trading at 85%. Trading means in market at 85 per share. Do you think this is the current share price? Yes, they're trading at 85. That's current price. It needs to borrow 1.6 million and is concerned about the level of fixed rates being suggested by the lenders. After lengthy discussions, the lenders are prepared to offer finance against a mezzanine issue of a fixed 5-year notes with warrants attached. Each 10,000 note repayable at par would carry a warrant for 100 equity shares at an exercise price of 90 per share. The estimated volatility of the returns on the company's equity is 20% and the risk-free rate of interest is 5%. The company does not pay dividends to its equity investors. You may assume that the issue of loan notes will not influence the current value of firm's equity. The issues will be made at par. Now, estimate using a Black-Scholes option pricing model the current value of each warrant to the lender, noting the assumptions that you make in your valuation. Now, don't be happy that you get 10 marks for computation. No. Estimate using Black-Scholes the current value of each warrant. You need to find value, estimate the value of warrant using Black-Scholes. So value means premium. You need to find premium using Black-Scholes. Noting the assumptions that you make. You also need to note the assumptions. So I will tell you assumptions of VSOP as well. But first thing is that you need to estimate the value of this warrant certificate. Warrant is a certificate, and then you need to tell the assumptions. Okay. Now I have been told to estimate value of each warrant, certificate, whatever, through VSOP. That's the purpose of VSOP, is find the value, or that is premium. So you need to find value through VSOP. Now I have told you, if you need to find value through VSOP, follow a 5-step pattern. Okay. Step 1. I told you to find PA, PE, R, S, and T. This is the first step, PA, PE, R, S, T. Now just giving you a minute and opening the question in front of you. Highlight what is the PA, PE, R, S, and T. Just highlight. Okay, so as far as this thing is concerned, that I told you to find the value of options, and the value of options is computed through VSOP. Okay, so basically the objective of VSOP is to find value of options, and we have already discussed that whenever you need to find the value of options, it would be through a 5-step approach. Okay, so the first step is find PA, PE, R, S, and T. Okay, so as you can see, the meaning of PA, I told you it's the current share price. The meaning of PA is the current share price. So you can clearly see that the current share price is 85. PE is the exercise price. Exercise price is 90. Volatility deviation is 20%. Risk-free rate of interest are 5%. And what is the time period in years mentioned? It's 5 years. Okay, so we just have to write it here. So I will write here PA as the current share price, which is 85. PE as the exercise price, that is 90. R is the risk-free rate. So what is the risk-free rate? It's 5%, 0.05. And S is the volatility or deviation, that is 20%, 0.2. And T is the time to expiry, that is 5. Okay, so this makes it the first step. Okay, now what is the step 2? Step 2 is to find E minus RT. Okay, E power, for power we use this, minus RT. Okay, now E is the exponential value constant, 2.7183, power minus R dash T. So what is R? Risk-free rate, 0.05, and T, the time to expiry, is 5. Okay, I can just enter it into a formula here to get it directly. 2.7183 power minus 0.05 steric, okay, 0.77, etc. Any questions on the first 2 steps you can ask, please? Time period of project, Mohammed Nizami. Actually, Strindi, Excel makes life easy because it works to full decimal places. Okay, so you don't need to adjust anything. However, if you are giving a paper-based exam, so you can just write it to 4 decimal places. Irony, I didn't computed the exponential value thing. It's a constant, 2.7183. Okay, so there are some students who are saying they need a break, and because of step 3, step 4, it's going to take at least 30-35 minutes. So better we should pause here, and we will resume it after that. Okay. Afzal, discounting is only in investment appraisal. When options come mixed with investment appraisal, it's not the case here. Okay, so let's take a short break and then we will resume. Okay. 10 minutes, Nizam. Okay, so let's resume the class now. So we were discussing the question of this Alaska salvage, and through BSOP you were asked to find the value of warrant. So BSOP basically finds value of premium. So I've told you a 5-step approach. The first step is to find PA, PE, R, S, and T. So we did this step 1, PA, PE, R, S, and T. Then in the second step, it was to find E minus RT. I told you E is the fixed value 2.7183. Power minus RT, so it's minus R multiplied by T, it's 0.7787. Okay. Then in the third step, I've told you to find D1 and D2. Let's find D1 first. Now the formula of D1 is ln, the numeric log in the calculator, bracket PA over PE, okay, plus bracket open R plus 0.5 S square, bracket close T over S root, okay. So basically, when you apply this formula, it's better to do it on a calculator, or you need to show each and every step. It's completely your choice. So first ln PA over PE. So T1 is equals to ln bracket open PA over PE. What is PA? 85 over what is PE? 100 plus bracket open, see the formula, R plus 0.5 S square bracket close T. So in bracket R plus 0.5 S square. So R is 0.05 plus 0.5 S square steric S 0.2 square power 2 R plus 0.5 S square bracket close T. What is T? 5. Whole of this is being divided by S root T. So whole of this should come in the bracket and get divided by S root T. So what is S? S is 0.2 multiplied by root T. Now to make anything root, 5 is the T. To make anything root, you apply power 0.5 in Excel. Okay, so this is the formula of D1. ln PA over PE. This was the first thing, that ln PA was 85 and PE was 90 plus R 0.05 plus 0.5 S square. So S is 0.2 square multiplied by bracket plus 5 open over S root T. So the D1 value is 0.6548. Okay. After the class, you can calculate it yourself to know whether you're applying the correct thing or not. Then you need to find D2 here. Step 3 is find D1, D2. The formula of D2 is easy, D1 minus S root T. D1 minus S root T. So D1 is 0.6548 minus S. S is 0.2 root T, multiply by root T. So T is 5, and to make it root power 0.5. 0.2076. This is your third step, T1 and T2. Any questions in step 3? Freya, it's R plus 0.5 S square, not just R plus S square. Yes, Mohammed Afzal, you can do that. Because whenever you input a formula, examiner just has to double click on that to open the formula, and then that would be it. Okay, now one thing I'm telling you, which would be helpful for you, that once you do the step 1, find PAP, RST, step 2, E minus RT, then step 3, D1, D2. So when you find D1 and D2, remember that the value of D1 and D2 must be restricted to 2 decimal places only. So this 0.6548 should be restricted to 0.65. Okay, why you will just know shortly. And this D2 value 0.2076 must be restricted to 2 decimal places, 0.20 or 0.21, rounded off. It's your choice. Okay, so restrict the value of D1 and D2 to 2 decimal places, and after that move towards the fourth step, which is to find ND1 and ND2. Now pay attention to this step, because this has been a step which creates challenge for students. Now to find the value of ND1 and ND2, you have to refer in the distribution table, the normal distribution table that is given in the exam. This is a real exam question. And see, you are firstly provided with present value tables. Then you are provided with annuity tables. And then you are provided with standard normal distribution tables. So to find ND1 and ND2, you need to refer to the standard normal distribution table. Now, before using this normal distribution table, just keep reading or read what is written in the last 2 lines in this table, in order to get a firm grip of what you are doing. In this table, first read what is written in this table in the last 2 lines. This table can be used to calculate ND, the cumulative normal distribution functions needed for the Black-Scholes model of option pricing. If D is greater than 0, DI, that means if D1 or D2, DI means the number, D1 or D2. If it's greater than 0, if D1 is greater than 0 means it's positive. If D1 is greater than 0 means it's positive. add 0.5 to the relevant number above. And if D1 is less than 0, means it's negative, subtract the relevant number above from 0.5. Now the value of D1 and D2, although you just did here, the value of D1 and D2 is coming positive, but it can come negative as well. So it is saying that if the value is positive, add 0.5 to the relevant number above. And if the value of D1 and D2 is negative, less than 0, deduct 0.5 from the relevant number. Okay, so how will you do it? Now, what is the value of your D1? It's 0.65. Okay, and what is the value of D2? It's 0.2. Okay, to find ND1 and ND2, you need to first see what is D1, D2, because you are about to find ND1. So first see what is D1. You're about to find ND1. Okay, I'm back. Hello. Okay, guys. So there was a short connectivity disruption, but I'm back now. Okay, let's take the questions first, then I will go back towards the issue which we were dealing. Balajavan, your D is 0.0065. You're doing it wrong. So just correct it and try to calculate it again. So anyways, I was talking about this, that in order to find ND1 and ND2, you need to refer to the distribution table. To find ND1 and ND2, you need to refer to the distribution table. Now, don't worry, my webcam is off for a few minutes till the connectivity issue is resolved. So my screen and my voice is clear to you. Okay, so to find ND1 and ND2, see the step 4, ND1 and ND2, you first need to find D1 and D2. You first need to find D1 and D2. Okay, now what is this D1 and D2? D1 is 0.65 and D2 is 0.21. You need to split it into two parts, one single digit and one double digit. Like 0.65 will be broken into 0.6, 0.05. If it's 0.91, break it into 0.9, 0.01. If it's 1.021, 0.02. Okay, if it's 0.86, 0.8 and 0.06. Okay, break it into one single digit and one double digit place. Okay, so once you have broken it into two pieces, like D1 is 0.65, so you broke into 0.6 and 0.05. Now you refer to the distribution table. You broke it into 0.6 and 0.05, you refer to the distribution table. Go to the distribution table and you will see 0.6 and 0.05. Try to find what is at the intersection of 0.6 and 0.05. So 0.6 is this row, the one which I'm highlighting, 0.6, and go to 0.05, double digit column. As you can see, in rows there are single digits, in columns there are double digits. So 0.6 is the row and 0.05 is the column. So at the intersection of 0.6 and 0.05, I am finding 0.2422. At the intersection of 0.6 and 0.05, I am finding 0.2422. So at the intersection of 0.6 and 0.05, I found 0.2422, right? But since D1 was positive greater than 0, as per the last two lines, I need to add 0.5 to the relevant number. It's going to be 0.7422. ND1. Practice more, practice more. You need to find ND2. So first pay attention to D2. You need to find ND2, pay attention to D2. It's 0.21. Break it into two pieces, single digit 0.2, double digit 0.01. Once you broke it into 0.2 and 0.01, again go to the distribution table. 0.2 single digit row, 0.01 column. So 0.2 and 0.01 intersection. This shows 0.0832. 0.0832. So it's 0.0832. And had it been D1 negative or D2 negative, I would have deducted 0.5. But since it's positive, I need to add 0.5 to the relevant number. This makes it 0.5832. So my D1 and D2 is 0.7422 and 0.5832. If you have any questions or you want me to repeat, please drop in the questions and then we can address. So in step 4, for D1 and D2, sorry, ND1 and D2, you first need to have D1 and D2. Okay, so D1 and D2 is 0.65 and 0.21. You need to break it into single digit and double digit. 0.65 needs to be broken into 0.6 and 0.05. 0.21 needs to be broken into 0.2 and 0.01. Once you break it into single and double digit, go to the distribution table. 0.6 and 0.05 means 0.6 row, 0.05 column. Okay, so at the intersection of 0.6 and 0.05, we are finding 0.2422, but since the value was positive, we need to add 0.5 to the relevant number. It's 0.7422. And secondly, it was D2, 0.21. So you broke it into 0.2 and 0.01. Once you broke it into 0.2 and 0.01, see the value 0.2 and 0.01. It's 0.0823 in the distribution table. Add 0.5 to the relevant number. It's 0.5832. So the value of ND1 is 0.7422 and for ND2 is 0.5832. At demo, we are solving Alaska salvage, and it's present in the handout. So I just need to complete the 5th step, but I'm just putting the screen for a minute so you can do this. Abid, you can try on point 2. It's no problem. Akinwumi, you are absolutely right. You need to deduct 0.5 from whatever the value you're getting. So for ND1 and ND2, you first need to refer to D1 and D2. Whatever you have got in place of D1 and D2, just break that into single digit and double digit. Go to distribution table, single digit row, double digit column, find the value. If it's positive, add 0.5. If it's negative, deduct 0.5. Okay. Now the last step, that is step 5. Is to find the value of call or put option. Okay, so we need to use the formula of option again. So let's apply the formula of call option, PAND1. So C, call option value. To PA. PA is 85. Steric ND1. What is ND1? 0.7422. Minus PE ND2 E minus RT. Minus PE. PE is 90. Steric ND2. ND2 is 0.5832. Steric E minus RT. So E minus RT in step 2 is 0.777. This gives you the value of call option. You can input the formula in Excel as well or solve it with calculator. It's 22.2. This is the call option value. That means this is the premium we need to pay in order to take this option. Okay, any questions? Else copy. Amna, we are not just, that means that's not our student level, especially when you're giving a professional exam that your answer need to get exactly matched with the examiner answer. Examiner answer, I just saw it's 22.41 and you're reaching 22.21. It may be due to decimal discrepancy. The marks is not of answer of working steps which you have done. So I can never try to bring my answer just like reading the examiner answer. So I don't think that's a problem. Esther, there is no rule, but the only restriction is on D1, D2. The only restriction is on D1 and D2. D1 and D2 must be restricted to 2 decimal places. Yes, Kritika, you will get the rest of the marks. Don't worry about it. Maureen Grant, the question never mentioned that we already have shares. We are willing to get this option. So it's a call option. But anyways, I advise students, if they are confused whether it's a call or a put option, to be on the safe side, calculate both. No need to worry about it. Okay, now in the theory notes which I have shared with you, it's also present, and I need to explain this because it's a requirement of this question as well. Now this BSOP model carries some assumptions. You need to know about those assumptions. Okay, that's written in the theoretical document, but still. Okay, the first assumption of BSOP model is that any option provided is always European option. Okay, you are assuming that whatever option is provided to you, that's always a European option, because BSOP doesn't consider American style options. Okay, first assumption. Second, no dividends are paid during life of option. Now listen to this point carefully. Listen to this point carefully. Now see, let's suppose you bought 1,000 shares of a company. Please pay attention to my first example which I gave you. Let's suppose you bought 1,000 shares and suddenly the company announced dividend. It will be yours. Let's suppose you bought 1,000 shares and the company announced dividend, that would be yours. But let's suppose you didn't bought shares, you just took an option, which either you will exercise or if it goes against you will leave. You just bought a right and suddenly the company announces dividends. Both of you, the buyer of the option and the seller, they will fight. You will say, okay, I took the right to buy option, this dividend is mine. He would say, you just took the right, you can back off anytime. So this is not yours. So it will be a fight. What is the end result? BSOP says we can't answer. We don't know anything about dividend. Therefore, assume in this model that no dividends are paid, because if dividends are paid, this will lead to a fight, conflict. Right? So BSOP assumes there is no dividend, because if there are dividends, both parties will enter into conflict. Okay. Third, BSOP also assume there are no transaction costs or taxes. You have just seen BSOP formula. There are no transaction costs or taxes involved. Okay, if there are any taxes, BSOP fails to answer them. And shares are continuously traded. There are no off days. Share prices regularly fluctuate because shares are constantly traded. They never stop. If trading stops, the price will come on hold, but there is no point of prices getting on hold. The share prices regularly change. That's the feature that markets are always open, because if markets get closed, they might have to open them again and incur transaction cost taxes, but they ignore that. Therefore, shares never stop trading. They are continuously traded. These assumptions must be learned from the theoretical handout which I provided to you. We have covered option pricing theory as well, and it was a very straightforward thing. If you follow these 5 steps, that first find BAP RST, then E minus RT, then step 3, the D1 D2, then ND1 ND2, and then the call and put option value. Okay. Now one thing in options is that options can be anywhere. Options are in currency risk management. See, call option, put option. Okay, we have studied. Options are in interest rate risk management. We have studied that as well. In interest rate risk management also, you saw options, right to buy, right to sell, premium payable. Options are also in investment appraisal. When you're finding NPV of a project, you also have some options. Okay, so there are usually 3 options in investment appraisal. I'm writing them down quickly, copy so that I can explain. Okay, Kritika, as far as your question is concerned, in the ACCA system, there are two things, spreadsheet and word processing software. So it's up to you. You need to answer calculation on spreadsheet and wordings on Word, both on Excel. It's your choice. Yes, these standard assumptions are applicable everywhere. Kamran Ahmed, which Word file you are talking about? Kindly clarify, please. Okay, so once there is some connectivity issue and the webcam is off, everybody starts getting worried that, okay, lecture is stuck, no voice, because I told you that I'm giving you time to copy this stuff. So don't get worried in just 1 or 2 minutes. Wait for 1 or 2 minutes. Like there are 3 people attending this webinar from the administration team of ACCA. If anything gets stuck, there's a problem, so they immediately tell me that there's a problem and I resolve it. So you please don't get worried regarding there's no voice or camera issues or stuff like that. Sometimes I give copying time, I pause it on my own. Okay, so just a final discussion on options. That options come in currency risk management, they come in interest rate risk management, you've seen them. They sometimes come in investment appraisal. Now in investment appraisal, it's all about NPV, you are investing in a project. In investment appraisal, it's all about NPV, you are investing in a project, okay? Now let's suppose you entered into a 5-year project. For example, you entered into a 5-year project, okay? Now the normal scenario is that you entered into a 5-year project, you invested, you get returns, NPV, that's it. Okay, you entered into a 5-year project, invested, returns, that's it. But once you enter into a 5-year project, sometimes it carries some options, like you started entering into a 5-year project and suddenly someone says you, okay, this is not the right thing. Start project 6 months later or 1 year later. Someone is giving you advice, start it 6 months later, 1 year later. Is it an obligation? No, they're just giving you advice, choice, start 6 months later, 1 year later. This is called option to delay. Why there is an option? Because it's not an obligation that you should start it 6 months later. It's just an option that you can delay. If there is an option to delay, we consider it a call option because you're not selling anything. It's call option. The PE, exercise price of this option when you will exercise, it's the initial investment you will incur cost. And the PA, the current value, is the present value of returns from initial investment. Okay. Let's suppose you enter into a 5-year project. You decided that I will enter into Asian markets. And someone gives you advice, don't enter only Asian markets, also enter into European markets. Is it an obligation? No. So again, an option. Don't enter into Asian markets, enter into European markets as well. Or don't just launch one product, launch 2 products as well. This is called option to expand. This is also considered a call option because you're not selling anything. The exercise price of this option is the additional investment. Okay. And the PA, current value of this, is the present value of returns from additional investment. While let's suppose you enter into a 5-year project, suddenly after 2 years, some government or some competitor comes and tells the, okay, you have ran this project for 2 years out of 5, sell it to us. They will give you a good price. Sell it to us. Don't continue this, sell it to us. This is called, this is not an obligation. They're giving you choice. This is called option to early exit. Since here you are selling the project, this is considered a put option. The exercise price of this option is the government or competitor offer, and the current value is the present value of opportunity cost, because once you exercise this option, your opportunity cost would be lost. Okay. Now, what will happen with this? That once you get an investment appraisal question, there might be a case that the first part of the question is going to be NPV. There might be a case that the first part of the question is going to be NPV. So to solve the first part of the question, that is NPV. Okay, you know how to compute NPV. Okay, and second part gives you either option to delay or option to expand or option to early exit. Okay, Second part gives you option to expand or option to delay or option to early exit. Okay, so if the question gives you option to delay or option to expand or option to early exit, it will then ask you to find its value through BSOP. You need to remember these principles. Value through BSOP is the 5-step approach. But what will you take as PAP? RST will be given in the question. But what will you take as PAPE and RST? You need to learn these. That and delay, what is PAP? RST will be given. Get the value of option to delay through BSOP. Okay. Option to expand. Option to expand. What is PAP? You will be provided. Okay. And you will be given option to early exit and asked to find the value. You need to find PAP. RST will be given. The value will be through BSOP. Like for example, just a short example to explain you. Okay, have a look at this question, please, just to get an idea of how things work. A company is considering to invest $5,000 in a project that will generate $2,000 each year for the next 4 years. Now, this is very simple because NPV, you have done difficult question as well. This is a very simple question. A company is considering to invest $5,000 in a project that will generate $2,000 each year for the next 4 years. Okay, it's fine. Discount rate 10%. Risk-free rate is 3%. Standard deviation is 20%. A competitor has offered that he wants to take project from us after 1 year for 4,000. In NPV question, this comes. Now, the first requirement is to find NPV. The first requirement is to find NPV. Now let's find NPV of this project. What is the life of the project? 4 years. Okay. How much did you invest? 5,000. And how much did you get each year? 2,000 each year for the next 4 years. Okay. No other cash flow is given. If it's given, no problem. You need to handle them. Net cash flows comes 5,000 each, and then 2,000. Okay. You need to find NPV. This is net cash flows multiplied with the discount factor of 10%. The 10% discount factor is 1, 0.909, 0.826, 0.751, and 0.683. You get the present values. 5,000 negative, 18.8 positive. One 652 1502 1366, and we just net them all to get NPV. It's 1338 positive. Now it's a very easy question of NPV, as you all know. It's basically an example, not a full-fledged question even. But even if NPV has a difficult scenario, that NPV has the first class investment, the revenue, selling price into units, inflation applied, then variable cost, fixed cost, taxable profit, import cost, currency conversion, NCF discount to present value NPV once you reach NPV. Now look at the second requirement. The second requirement is to find value of option. The second requirement is to find value of option. Now we all know it's 100% confirmed that value of option will be computed through PSOP. It's 100% confirmed that the value of option will be computed through PSOP. There is absolutely no other chance. The value of option has to be computed through PSOP. Now the first thing you will recognize is that this is a question with investment appraisal. This is a question. This is not just a random Alaska salvage question where everything is given and you're asked to find value of option. The current share price, the excess price, everything is given and you're asked to find the value of option. No. This requirement of value of option, it's guaranteed that it is going to be solved through BSOP, but it's coming with investment appraisal. So you need to first make your mind that there are going to be maximum 3 options. Either it would be option to delay, or option to expand, or option to early exit. There can't be any other chance. Either to be delay, expand, or early exit. So which option of investment appraisal with investment appraisal you are provided? Competitor has offered that he wants to delay the project, expand the project. No, he wants to take the project from us after 1 year for 4,000. This is an option to early exit, that the project life is 4 years, but the competitor is saying give project to us after 1 year. Option to early exit, find the value of option. The value will be found through BSOP, and we all know option to early exit is a put option. Option to early exit is a put option. Value will be found through BSOP. Value will be found through BSOP. Option to early exit is the put option. Value will be found through BSOP. Now, once you have made your mind that value will be found through BSOP, 5 steps. First step is PA, PE, RST. Once you have made up your mind that the value will be found through BSOP, 5 steps, PA, PE, RST. Now you need to learn PAP. R is very easy, risk-free rate. It's given in the question, 3%. As standard deviation is also going to be given 20%. Time to expiry, how much time the supplier is asking? 1 year. They give a project to us after 1 year. 1 year is the expiry period. This option won't be valid after 1 year. Now PAP, the PE of this option, to exercise this option, you will get cash of 4,000. It's a government or competitor offer. And PA is the present value of opportunity cost. When is he asking the project? Here, after 1 year. So do you think if you take this option and give the project to him, other 3 years cash flows will be lost? This is the present value of opportunity cost. This is the present value of opportunity cost, because once you take this option, your 3 years benefit would be lost. This is the present value of opportunity cost, 1652 plus 1502 plus 1366. 4520. Any questions with the first step? Result is the time to expiry. This option is valid for how long? He's asking us to give them project after 1 year. So this option is valid for 1 year, not after that. Yes, Satya, they're the same. It's PE. PE, I just wrote above in option 2 early exit is the government offer or competitor offer. So competitor is offering you 4,000 for that. As a rate of number of years delayed. It's present value of opportunity cost basically, Ayuni. If you will sell the project to him after 1 year, the other 3 years cash flows would be lost. That's the present value of opportunity cost. Okay, so I think the first requirement NPV was clear to everyone. Okay, then in the requirement it asks for value of option. Now you need to make sure that this is not an Alaska salvage question. Here the option value is being asked after NPV, so it's mixed with appraisal. In appraisal, if it asks value option, there can be three options: expand, delay, early exit. Which one of the three is here? Because the first two are called, the third one is free. Here the option is not to delay or expand, it's early exit. So the value of option, this is an option to early exit, this is a put option, value will be found through BSOP. Once you decided the value will be found through BSOP, 5 steps. Okay, first step, PA, P, RST. RS and T are given. PE is the government or competitor offer, so government or competitor offer is 4,000. And PA is the opportunity cost, because once you sell the project to him after 1 year, the remaining years cash flows would be lost. That's the present value of opportunity cost. Okay. Now the second step is E minus RT. E is the exponential value, 2.7183 power minus R. It's 3%, 0.03. T is 1. So 2.7183 power minus 0.03. It's 0.97. Okay. Third step, D1, D2. You have the formulas for D1 and D2, refer to them. D1 is LNPA over PE. So LNPA 4520 over PE 4,000 plus bracket open R plus 0.5 S square T, R 0.03 plus 0.5 S square, 20% square, T is 1 year over S root T, 0.2 root 1. You will get the D1 value. It's 0.861 and D2 is D1 minus S root T, 0.2 root 1, so 0.661. Okay, so I've told you to restrict them to 2 decimal places, so 0.86 and 0.66. Okay, now in step 4, you need to find ND1 and ND2. I have told you to find ND1 and ND2, you first have D1 0.86. Break it into 0.8 and 0.06. And ND2, you have D2 0.66, break it into 0.6 and 0.06. Okay, now you need to refer to the normal distribution table. So it's 0.86, go to the intersection of 0.8 and 0.06. At the intersection of 0.8 and 0.06, it's 0.3051. Okay, positive value, add 0.5. 0.8305. Okay, and ND2 0.66. Find the intersection of 0.6 and 0.06. So at the intersection of 0.6 and 0.06, it's 0.2454. So once it's 0.2454, positive value means add 0.5. 0.7454. Okay. And finally, you need to go to step 5. Find the value of call and put option. Okay. Now option to early exit is a put option. So you need the formula of put option. Now, if you look at the formula of put option, its put is equals to call C minus PA plus PE into E minus RT. So it's call minus PA. PA is 4520 plus PE into E minus RT plus PA. Sorry, it's call minus PA 4520 plus PE 4000 into E minus RT, which is 0.97. That means for this purpose, I would be needing call value. First find call value as well, because to find the value of put, you need the value of call as per the formula. Call is PA ND1. PA 4520 into ND1 0.830 minus PE 4000 into ND2 0.74 E minus RT 0.97. It's 859.6. And here this 859.6 is needed. So 4000 into 0.97 minus 220, the put option value or the premium you have to pay to get this option. Okay, so this has been mixed with investment appraisal as well. Any questions, please ask. Make it 0.8051. There was a calculation mistake slightly. Thanks for the student who told me this. Slight change in values then. Okay. Keshav, there is no need to show such example where D1 is negative. You can just do any question where D1 is negative. In case negative, you just need to deduct 0.5 from that number. 0.5 minus table value, because if you read the last two lines, Sayyid Mubin, clearly, it's written if D1 is positive, add 0.5 to the relevant number above from the table. And if D1 is less than 0 negative, deduct the relevant number above from 0.5. So the above number has to be deducted from 0.5. So we have covered options today and the BSOP plane with investment appraisal as well. What you can do is that you can refer to the day one question after the class, the investment appraisal question, day one, which we covered. And in that question, you can read that question again and now solve part two, because part two has this thing. Okay, day one question of investment appraisals, part two has that thing, requirement two had this thing. Yes, Nizam, in that case, only C has to be calculated. Timothy, if the option of to early exit is valid, if it is giving you option to buy the project at year 4, that means this option is valid for 4 years, so T will be 4. Okay, assumptions of PSOP are in the Alaska salvage handout shared today. Nizam, you don't need to copy that, it's in the handout. And the example, I will share the screenshot on the WhatsApp group, don't worry. If there are no questions to practice because you need to practice as much questions as you can. I can just tell you some important topics which will be I told after tomorrow's class because I have to research on them. However, it's strongly recommended to practice as many questions as possible. Like I just gave you a hint that you want to practice the BSOP day one questions part B is there. Okay, so I think we should end the class here and we will meet tomorrow in our final session. Okay. Yes, Anatoly, you're right.